Today, let's talk about earnings gap and earnings shocks. These two metrics help us understand how the market reacts right after a company reports earnings. First, let's add the fields. Click here to add earnings gap, and now let's also add earnings shock. Day 0 is the earnings day, and then day 1, day 2, and day 3. Earnings gap shows when a stock opens with a gap compared to the previous day's high or low. It can happen on the earnings day itself or on the following days. Earnings shock tracks the cumulative performance gain over several days after earnings. It shows whether the stock continues to rise or fades after the initial reaction. Now, let me show you on the platform. If I bring the earnings shock field, I can measure the follow-through. For example, this stock went up 19% on earnings day and then added another 4% the next day. If I select the field earnings gap, for example, DHI had an earnings gap of 8.5% on day 0. And by the end of the session, the earnings shock reached almost 17%. The benefit for traders, by combining both fields, we can spot the stocks that had the strongest initial reaction and continued higher in the days after. That's usually a clear sign that investors are really behind the move. Thank you for watching. Enjoy the platform and don't forget to do your own research.